Most people have never actually lived through a real bear market, and that blind spot is about to cost them everything they think they know about their own money. A bear market is not a bad week. It is not a correction, a dip, or a momentary panic. A bear market is a sustained decline of 20% or more from recent highs, and it does not end because the news cycle gets bored. It ends when the economic reality that caused it finally gets priced in, no matter how painful that process is. The last full bear market in U.S. equities, from October 2007 to March 2009, destroyed over $11 trillion in household wealth. The S&P 500 fell 57%. People who were 55 years old with $1 million retirement account watched it become 430,000, and many of them never recovered. That is not a chart. That is a life. What makes a bear market different from a correction is the psychological rot that sets in. During a correction, people tell themselves it is temporary. During a bear market, they start to believe the system is broken. Companies that were considered bulletproof start cutting dividends. Layoffs move from the tech sector to the industrial sector to the government sector. In 2008, the United States alone lost over 800,000 jobs per month at the peak of the destruction. In the Eurozone, youth unemployment in Spain hit 56%. These are not abstract numbers. These are families deciding whether to pay the mortgage or buy groceries. This is what a bear market feels like from the inside, and most people watching this have never experienced one as an adult with real financial obligations. Here is what most people get wrong. They think a bear market is a stock market problem. It is not. A bear market is a symptom of a deeper structural shift in how capital flows, how governments behave, and how entire economies are wired. When the dot-com bubble burst in 2000, it was not just about overvalued tech companies. It was about the realization that the entire narrative of infinite digital growth had been priced as if it were already real. When the 2008 financial crisis triggered a global bear market, it was not just about bad mortgages. It was about the discovery that the global banking system had built a house of derivatives so complex that even the people running the banks did not understand the risk they were carrying. And when China's stock market lost over $4 trillion in value in the summer of 2015, it revealed that the Chinese government's entire strategy of propping up equity prices with borrowed money was fundamentally unsustainable. The pattern is always the same. A period of irrational exuberance builds an asset bubble. Central banks or governments try to manage the bubble without popping it. They fail, the bubble pops. And then the real economy absorbs the shock through job losses, bankruptcies, and a painful repricing of everything people thought was valuable. The bear market is not the disaster. The bear market is the cleanup after the disaster. So how do you survive one? The first thing to understand is that cash is not trash during a bear market. During a bull market, holding cash feels like a mistake because everything is going up and you are sitting on the sidelines. During a bear market, cash becomes a weapon. It gives you the ability to buy assets at prices that would have been unthinkable 6 months earlier. Warren Buffett did not become one of the richest people in the world by buying at the top. He became rich by having the liquidity to buy when everyone else was forced to sell. In 2008, while the world was falling apart, Buffett invested $5 billion in Goldman Sachs at terms that were essentially a bailout of his own portfolio. He had the cash because he had been disciplined enough not to chase the bubble. The second principle is to understand that diversification is not just about owning different stocks. It is about owning different asset classes that behave differently under stress. Treasury bonds, gold, and certain commodities tend to hold value or even appreciate when equities collapse. During the 2008 bear market, gold rose from around $800 per ounce to over $1,000, while the S&P 500 was in freefall. If your entire net worth is tied to a single stock market in a single country, you are not diversified. You are concentrated, and concentration is what destroys wealth in a downturn. The third principle is the hardest one emotionally. Do not check your portfolio every day. The psychological damage of watching your wealth decline in real time leads to panic selling, which is the single most destructive thing an individual investor can do. Studies consistently show that the majority of retail investors who sold during the March 2020 crash locked in losses that they would have recovered from within months if they had simply done nothing. The people who survived bear markets historically were not the smartest. They were the most patient. The fourth principle is to recognize that bear markets create the next generation of wealth. Every major fortune built in the last 50 years was seeded during a downturn. The companies that dominate today, from Microsoft to Amazon, were either born or fundamentally reshaped during periods of economic chaos. The bear market does not just destroy, it clears the ground for what comes next. The real question is not whether another bear market is coming. It is whether you have built your financial life to survive one. Because the next one will not look like the last one. It will be triggered by something the consensus is not watching, and it will punish the people who assumed the good times were permanent. That is not a prediction. That is how every single bear market in history has worked.